Thanks for listening in. This is the K-State Radio Network and Agriculture Today. Well, we are catching up once again with Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, for his regular visit. And we're into a tax topic, very pertinent for this time of the year, Roger. We're looking closely at the proceeds that a crop producer might gain from their insurance coverage in the case of a crop loss and how those can be handled for tax reporting purposes. Actually, one can defer those proceeds to the next tax year. This is something that's been out there as an option for producers for some time, hasn't it?
That's right, Eric. It's been in the code for quite some time. And the principle of this is just one of consistency, and that is because many farmers normally defer the income from their crop sale proceeds into the next tax year. The question then became, well, what if I don't have crop income because my crop was destroyed by weather or it's damaged somehow? And now I get crop insurance proceeds. Well, Congress came up with a rule and has put it in the Internal Revenue Code, and IRS has given us regulations laying out the procedures to do this. And what Congress said you could do is, well, you can keep your same tax reporting of that crop income that you would have normally sold next year. You can do that with the crop insurance proceeds.
There are certain requirements involved to qualify for this deferral, though, Roger.
That's right. Congress has laid out a couple of things in the statute itself, and one thing that's very clear is that you have to have actual physical damage or destruction to the taxpayer's crops, and that's key. So you have to have physical damage or destruction. You have to be able to establish that. You have to prove that to the satisfaction of the IRS, which means you're going to have to do something else. We'll get into that in just a moment. Mm-hmm. And you have to have had a normal business practice of reporting the income from that crop that was damaged for which you got crop insurance proceeds. Your normal business practice must have been to, or would have been to, report that income in the following year. So if you get those two aspects, you're going to meet the statutory requirement, and then you can defer the crop insurance proceeds into the next year. The other thing that's in the statute, I want to make sure we mention this, is that it also includes inability to plant crops. So if you get prevented planting payments, those are treated as crop insurance for purposes of the deferral provision, and also federal disaster payments. If they're received for drought, flood, or any other natural disaster, those are also deferrable. So we really have three things. We've got the traditional crop insurance that pays for actual physical damage or loss. We can defer that. We can defer prevented planting payments, and we can defer federal disaster payments.
Mm-hmm. Might point out, as part of the disaster payments, the WIP program that the USDA provides would qualify as crop insurance for this purpose?
Yeah, that's the same thing as crop insurance, WIP or WIP plus. And again, the other thing I would mention with all of these things that can be deferred, if you had damage, say, in 2021 and you got the payment in 2021, you can defer it into 2022. If you had damage in 21 and you didn't receive the insurance payment until 22, that's already been deferred. Mm-hmm. So you can't defer that then into 2023. So it's a one-year deferral from the year in which the crop damage or prevented planting or disaster occurred.
In a moment, we'll talk about the kind of insurance coverage that may actually get into revenue as well as productivity. But as one files for this deferral, they have to have substantial proof, if you will, of that loss, don't they? They have to fill some boxes here, so to speak.
Well, yeah, they have to clear one other hurdle, and this is one of those boxes. If you're checking off boxes on a list, there's a 50% test. So in order to be eligible to make the election, which is another point that we're coming to defer, you have to be able to establish that a substantial part of the crop income, defined as more than 50%, would have been reported in the following year under your normal business practice. So I go back to what I said earlier. If your normal business practice is to defer the income from the crop, you can defer the crop insurance proceeds. Gotcha. Now, how much do you have to defer? You have to have a normal business practice of more than 50% of deferring the crop income. So you have to be able to establish that to the satisfaction of the IRS. Mm-hmm. Now, the other box-checking thing that you're mentioning here is that this is by election. This doesn't just happen automatically. You have to make an election with the return, and that is done by attaching a separate signed statement to the return or an amended return for the tax year for the year of damage or destruction. And you've got to have a bunch of stuff that is laid out in the regulations included on that attachment. You have to declare that you're making the election. in accordance with the code. You have to identify the specific crop that's been destroyed or damaged. You have to state that it's your normal business practice to defer the crop income. And you have to note the cause of the destruction or damage of the crops and the date on which that destruction or damage occurred, and then specify the total amount of insurance payments that you received and who you received it from, who were the insurance carriers, and then give the name of that insurance carrier or carriers. And you attach that separate signed statement to the return and file it.
Those are the procedures then. And, of course, there would be the obligatory IRS tax forms that one has to fill out to clear the way for them to defer these crop insurance payments. One's tax advisor can fill one in on that. We have seen the advent in, well, it's been quite a few years now, of newer kinds of crop insurance products. And they are based on revenue guarantees. They're based on yield protection. There's a group risk plan out there. All of these, by their orientation, go beyond just physical damage inflicted to a crop by storm or other natural disaster. And those kinds of, let's call them expanded coverages, are handled differently with respect to the ability to defer the proceeds from them.
Yeah, this really goes back to the 1996 Farm Bill, and unfortunately in the 25, 26 years since then, the Congress has never amended the statute. And again, the statute requires that the insurance be paid based on actual physical damage or destruction to the taxpayer's crop. Mm-hmm. Well, the new types of crop insurance might be things such as revenue-based policies, yield-based policies. You got all types of newfangled insurance. But without the code recognizing those new types of insurance, only portions of these types of insurance that are paying on revenue or yield would be deferrable because only a portion of those payments would be attributable to actual physical damage or destruction. Basically, to make a long story short, the portion of the insurance proceeds that can be deferred relating to yield would qualify. The portion that's related to price would not be deferrable. And I think crop insurance agents in many instances will be likely able to break those out for a farmer. But in a recent article that I wrote that's posted on my website, I go through a formula with some scenarios here based on market price and what your revenue guarantee is under the policy, and show how you can work your way through this based on your actual yield to determine the portion under a revenue-based policy that would actually be deferrable and the portion that's not deferrable. Now, that's not I have run it past National Office of IRS. They have said that looks good to us in terms of how you do your allocation, but to this day, there still is no formal announcement by IRS on what is the appropriate procedure to do your allocations.
But one would be relatively safe in doing this calculation and taking advantage of at least the yield loss portion of their coverage. And we won't walk through the entire formula here. That would be a bit clumsy on radio, but we would defer folks to, if you will, Roger's blog on this topic, which fills in the details in full here. Roger, this is an opportunity for producers to take advantage of the flexibility here as long as they follow the process as it's intended.
Yeah, basically what producers need to remember is that this is a provision that allows them to continue their traditional way that they would report crop income in the event that they have some damage to the crop and they get crop insurance proceeds. We want to continue that same tax reporting of deferral if that's what you've been doing. And just keep that in mind, and you can refer to the article for all the details on that.
Very well. And that article is at the blog site washburnlaw.edu/WALTR. On the blog link toward the left-hand side of that page, the article is entitled Income Tax Deferral of Crop Insurance Proceeds. And as you're working through your tax reporting, producers, be sure to be aware of the latitude that you're afforded here in as far as your crop insurance returns. Roger, we appreciate the word. Many thanks to you as always.
Thank you, Rick.
That's Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law. And while we've a moment, just to follow up on that website, tremendous resource of information, the Washburn Agricultural Law and Tax Report. It thoroughly covers legal and tax issues that you agricultural producers, as well as those in agribusiness and rural landowners, routinely face. Agriculture is uniquely treated by our legal and tax systems, as a matter of fact. For anyone involved in agriculture, either as a producer of commodities, as a consumer, or at any post, if you will, in the agricultural industry, this report can help you learn to identify agricultural legal problems and to become acquainted with the basic legal framework surrounding agricultural issues. And as Roger puts it, the tax concepts peculiar to agriculture. It's a very dynamic field with wide application to everyday situations, and the website is on top of it all. So we'd, again, refer you to it as a routine source of information for you. washburnlaw.edu/WALTR. We'll be back after this break. You're listening to Agriculture Today.